Hi, everyone. Today is August 22nd, 2024. We've got an election coming up in November. Interest rates may be cut in September. The economy is slowing down. So, should you be going a little more conservative? Are you wanting to stay aggressive? Is the right answer a little bit of both? That's what we're going to be talking about today. And I want to say this is so important that we spend one full day on how to protect your wealth and one full day on how to get hot. So, in my view, you actually want to do both. You want to be age appropriate with how much you keep safe. And then you want to add 4 slices of hots. Most of us, even if we have an aggressive plan, are not leaning hard enough into the things that are super hot, like artificial intelligence and breakthrough technology. And most of us who think we have a conservative plan have paper losses. So it's really important to replace blind faith and hope that your financial partner is protecting you. And you really have to know what you own. You have to know how to write your brokerage statements, or at minimum, if you don't know how to do this and you want, I do offer unbiased second opinions. I don't sell financial products. We're in the business of empowering you with the news, information, and education that you need to be the boss of your money. It's your money. If you get losses, it's your losses. You can't go to the broker and say, why'd you do that, right? So it's really important. And in these moments of shift and inflection, for us to especially know what we own. So the first thing I would say is we want to be age appropriate. I have a web app where you can check and see, gee, okay, let's say I have 100,000 or 1 million in my 401k, and maybe even all together with all of my accounts, my 401k, my IRAs, my checking, my savings. So how much of that do you want to keep in a certificate of deposit or a money market fund or bonds? And how much of that do you want to have at risk in equity funds or stocks, right? So that free web app can help you with that. The right formula is you start by keeping a percent equal to your age safe, right? Now, what's safe is a little tricky because bonds have paper losses. Money market funds are not FDIC insured and can go down in value. They also fluctuate with the interest rates. And of course, FDIC insured has limits. So how do you get safe in that world? Well, it is a little bit tricky, but it's possible. You just have to know what you're doing and pay attention to the fine print. And again, through my private coaching, I can help you with that. Can the broker salesman do that? Yes, they can in theory, but there is another thing to consider is that they really can only offer you the products that they have for sale. And there may be some ways that you can get safer outside of those products. And those products may have more risks and limitations than they're all going to be listed in the fine print, but maybe you're not reading them and maybe you're not getting the fine print read to you properly either. So super important to get that mix right and to be the boss of your money and to know what you own. So again, start with your age safe. We are actually overweighting safe in our sample pie charts because stock markets are high, real estate prices are very high, and the economy is slowing down. And so that usually is an indicator that we want to get a little more conservative. I don't think you should do all or nothing. But if you're always age appropriate and if you overweight safe, if you think that there's a reason why stocks can fall, then you have the liquidity, the emotional fortitude to buy low. I want to be reminding everybody that the reason most people do not buy low is that they can't. If you lose too much in a downturn, you don't have any liquidity to buy low. All right, so now we've talked about the slice system, right? So keep a percent equal to your age safe. We're overweighting 20% safe, which means that, you might have a smaller amount at risk, but in that smaller amount at risk, you still want to have about four slices of just what you think is the hottest thing out there. So you can get even more aggressive than most aggressive plans are in a way that's actually more conservative than most conservative plans are. Also, I want to talk a little bit about money market funds because, again, they are not FDIC insured. They can go down in value and they do typically fluctuate if interest rates get cut. So, we were talking in and by the way, I am doing a What's Safe masterclass, a bond masterclass after our October retreat, the Saturday after. It would be important to attend the October retreat and then go to the bond masterclass because the foundation for What's Safe is laid at the retreat. And then we take one full day to dive even deeper at the bond masterclass. But the long and the short of it is this on the money market funds is that a lot of people think that's a simple way. If you said, hey, I want to get more safe, and you go talk to your broker salesman, they're going to say, hey, well, why don't we put you in a money market fund? They're still paying, 4.5% or some other very nice interest rate, relatively speaking, high in today's world because we had rock bottom for, so long, right? But again, the fund itself can go down in value. They are risky, more risky than people realize. They are supposed to be safe and they are safer than equities. But they are a fund, right? So if you are investing in a money market fund with a fund company like FTX or Voyager Digital or one of these other companies that goes belly up, that's not FDIC insured. That's the first thing. Now, we have seen bailouts of money market funds in the Great Recession and in the pandemic. It's, not guaranteed to happen, but again, it's just a little riskier than people realize. So I want you to be aware of that. The other thing too is that, again, they tend to fluctuate when the interest rate gets cut, then the yield might go down on the money market fund. So you might want to think about, is there a way that I can actually, again, our mantra on bonds is going to be keep the credit quality high and the terms short. For short, I would say try to go under 5 years, right? And I would observe the fine print and FDIC insurance levels. So what that means is that let's say you had $1 million, and also you want to keep the money rolling back to you. Don't want everything tied up for 2 years. Because what if there's an opportunity for you to buy a home for your kids or buy a vacation home for yourself or downsize or move or whatever, right? So rolling maturity dates so you don't have everything locked up. And think about locking in maybe on a tranche of that or a piece of that, total that you have in for maybe a 2-year period at the FDIC insured level of a certificate of deposit with a highly rated bank. Again, don't just run down the street to your community bank because it might be, we have seen some bank failures. We know that there are a lot of banks that are have poor credit quality. They might still be investment grade, but at the bottom rung. So credit quality counts and duration counts, short term, high credit quality. Rolling maturity dates so that you don't have all your money tied up for a couple of years. So also, I wanted to just say that when people say they want to be aggressive, that actually indicates to me that you're letting your emotions drive things because everybody wants to be aggressive when they see that stocks are high or that they've made a lot of money. And then people want to be conservative if they think, at the bottom and they want to sell low. So what I would say is that if you feel like you're aggressive, then maybe you don't overweight safe, right? But you want to always be at least age appropriate or in that ballpark. Okay. Also, I wanted to talk a little bit about valuable assets that we potentially have that we may want to keep. So some of the things that we may want to consider keeping, especially I'm encouraging every one of us to start having a 3-generation view of our wealth plan. That includes our parents and our kids and grandkids. Okay, so that would be 4 generations. And I want you to think about how all of the various things that you own can be beneficial for your kids and or your parents. Also, how having everybody in all these separate spots, if there's some rentals going on, you're making landlords rich. Is there a way that you can start keeping the money in the family? remember that hard assets, even though they can go down in value in a recession, certainly in the Great Recession, we saw a huge drop in real estate prices, and we saw over 20 million foreclosures, from 2005 and in the wake of the Great Recession. So this is an issue, and you want to make sure that you are equity rich. If you purchased recently and you purchased at an all-time high, then you might want to be reconsidering that. I do have an updated edition of the ABCs of Money. There's an entire section on real estate, and I'm planning on publishing it within the next 3 to 4 weeks at most, may even be sooner than that. Okay. So that's something you want to check out. We just did a real estate masterclass where we talk about a lot of these things. If you would like access to the recording of that for a small price, email info@nataliepace.com or call 310-430-2397. But a couple of the assets that a lot of, especially baby boomers have, you might have an interest rate on your mortgage that's under 4%. So even though I think it's a very good idea, if you plan on staying in your home until you transition into the heavens, then it's a good idea to pay off that home by the time you retire. That way, the more bills that you can kick out the door, right? That's going to mean that you have more money to live a much richer life, because most of us are going to have a smaller fixed income than we have when we're an active earner. So that's one thing to consider. But the other piece of the equation is that, we want to be thinking about who's going to be living in that house after us, right? So 2 or 3 or 4% mortgage rate can be amazing. Now, I'm going to tell you a couple of stories of the way retirees played it differently. One is there was a retiree and she was like, you know what? I want to downsize even smaller anyway. I had this big, beautiful house when I was a mucky muck executive. That can bring me in so much money that with my, 401k and my pension, I'm going to be earning the same amount as when I was an active earner. And so that person then kept the low interest rate mortgage, had income coming in. Now her main primary home is now turned into an income property. She got into a much smaller space and she spent 6 months of the year traveling. There was another person, and she still is a big executive at a big company. And her son is married and has 3 kids. She wanted the kids to go to a good school, and she had a big, beautiful house in a gorgeous neighborhood with a great school. So she basically put the house into a trust, and that went to the kids so that the kids could start educating their kids in this great public school. And she got a smaller place for herself. So again, you want to think about the property and that low interest rate mortgage that you have as assets as well, that are pretty safe. Again, paper assets in a debt world can go down in value a lot more than the hard asset, especially the hard asset that you're getting an income from. So in short, I want you to think about having 100-year plan that includes 3 or 4 generations. I think there's a way for you to be both conservative and aggressive, but I would like for it to be age appropriate. If you need assistance in determining where you are on this spectrum, so you know exactly what you own and what a better plan looks like, I do offer unbiased second opinions. Email info@nataliepace.com or call 310-430-2397 for pricing and information. Also, we are going to have a 3-day financial freedom retreat. It's basically the life math that we all should have received in high school. It more than pays for itself, because you'll learn even how to save thousands of dollars annually in your budget. So that's going to be worth a tremendous amount of money over the years to come. And of course, if you protect your nest egg, that could be worth a great deal of money. We're hosting a brain trust adventure in Cornwall, England, for our spring equinox. That only has like 2 rooms available. So if you are interested, you need to look into it now. All of this and more at the homepage at nataliepace.com. Be sure to follow me on Instagram because that's where I do my daily money tips. So that's Natalie Wynn Pace, Wynne, which is my middle name. So thanks for joining me. I'm going to go ahead and pause real quickly just in case someone has a quick question. And again, I'll see you at our next one. We do these every month, youtube.com/Natalie Pace. So again, thanks again for joining me. I'm Natalie Pace at nataliepace.com and on social media. And by the way, we really, really want to know both your money triumphs and challenges. We're here to help. That's our job, and we love doing it. We want to add a splash of green to Wall Street and keep empowering Main Street with the news, information, and education that we all need to be the boss of our money. Thanks again. See you next time.